This idea of typically when people worry about the deficit, it starts to get priced in. It is not. Unless you think that what we're seeing right now with yields rising really has to do with that. Is that the case? Do you think that long end yields rising has to do with the deficit, or does it have to do with other factors?
Well, I think that it is, of course, the deficit is contributing to nominal GDP growth. It's contributing to inflation remaining closer to 3% than it is to 2%. So I don't think we just need to look at a risk premia in the market or in terms of the backup in long-term yields. We just need to appreciate the deficit today, 6.5% of GDP, but at full employment. So this is quite different than the deficits from a decade ago. Also similar proportion relative to the economy, 6.5%, but coming at a time when unemployment was 8%, when tax receipts were depressed, when social services spending was relatively high. So what's different here is that when you adjust for the state of the economy, the Treasury is injecting about $1.5 trillion of incremental liquidity into the economy. And that, I think, is something that people have to take into account when bond yields and, again, inflation, nominal GDP growth.
So we were talking before the break, and there is this question of whether we're actually just seeing people figure out that the neutral rate might be a lot higher. Right now we're pricing in about a 3.4% rate at the end of next year for the Fed funds. But right now it seems like maybe you think that the market is just adjusting higher and is going to kick that back up to something closer to 4. Is that right?
I think that's reasonable expectation. The way that I've related the current experience is similar to the taper tantrum. The reason I say that is because in 2012, everyone was convinced that bond yields were unnaturally low. The expectation was that as soon as the Fed stops purchasing assets, bond yields are going to spike and they're going to normalize. What happened, of course, when Bernanke in 2013 shocked markets, the Fed followed through, stopped buying bonds by the end of 2014. Within 18 months, bond yields were about the exact same level as when Bernanke first surprised markets with the suggestion. So then from that point on, people started talking about R star. They started talking about the fundamental determinants of real interest rates. And people recognized that monetary policy could not be the entirety of the explanation for why rates were so low. Today, I think that there was this expectation. We had this temporary spike in rates because the Fed was focused on maintaining credibility, getting inflation down, and that we would then go back to 2.5% thereafter. And now they're realizing that there are really seismic structural changes in the economy, the shock from AI, the industrial policy and the capital needs there, changing attitudes towards trade. And as when you accumulate these factors and you take stock of them, you end up with a inflation stabilizing interest rate that's probably closer to 4%. And I think this is just the market digesting that.
Do you think it's a mistake at this point for the Fed to cut further?
No, I think that as inflation goes down towards 2%, you would not suggest that this economy requires a real interest rate of 3% or close to 3%. So I think there's at least 2 more cuts that are coming, maybe a third, we'll see. But when the Fed first cut rates in September, the market had priced 10 cuts over the next 12 months. So I think it's just dialing back those expectations. But rates are still coming down. I think that's virtually assured.
Just really quickly here, even if the Fed doesn't cut, do you think that risk assets are in still a sweet spot, particularly in the private credit sphere?
Well, I think that what is underappreciated about this economy is that a relatively small share of GDP, relatively small share of the economy, is making such an outsized contribution to growth. According to our data, really it's about 4% of GDP, adding almost a full point to growth. That's of course data centers. It is that's the infrastructure, and in addition to the hardware applications, it's renewable energy generation facilities, green industry, things like EVs, battery, semiconductor fabrication plants. And so I think that this economy is actually performing better than expectations, certainly better than people expected 2 months ago as they really started to worry about a couple of soft months of data. And as a result, I think that there's reason to suspect that there's a lot more runway for growth than people had been anticipating.
So yes, it seems like a good time.
No, I think you have to worry about valuations. You have to worry about are credit spreads too tight. I mean, so there's there's a lot of complications, but I think the underlying the tailwinds are sufficient.